welcome back again to this channel. I go by the name Dr. Candles in the Building, aka the Humble Trader. So quickly, how banks trap retail traders trading the concept of what? Support and resistance. I hope you understand. So that will be our topic today, how they trap those retail traders trading support and resistance. I hope you understand. We all know support and resistance are basically turning point of the market. Whenever market hits a support area, it bounces back. Whenever it hits a resistance area, it bounces like that. So anytime a level is being created upward like this, the next time market gets to that level, retail traders usually anticipate to sell around that level, or whenever market hits a support level, retail traders usually anticipate to buy at that level. Now these banks know where those retail traders are selling, so because of that, what they do is that they trap these retail traders and then later move the market to their direction. Now, okay, so in the forex market we have two players, the market makers and the retail traders. The market makers are the banks, the hedge funds, those big financial institutions who are trading with large capital, large volumes. Those are the market makers. And then the retail traders are we, the individuals with our small money trading through brokers. We are the retail traders. Now, what you need to understand about forex trading is that anytime you want to buy in forex, somebody should be there to sell in order for your order to be executed. I hope you understand. So usually, whenever these banks wants to buy a pair, for instance, they have a pair that they want to buy at a volume of, let's say, 10,000. Usually, they will need an opposing orders, sell orders to match up with their 10,000. I hope you understand. So what they usually do is that they trap retail traders to be selling at an area that they want to buy. So once retail traders buy more and then they are able to fill all their orders, then they execute the sell opportunity for the market to drop, which will eventually make retail traders lose in the market. So assuming market is trending down, up like this, and then it gets to an area of interest, maybe a support and a resistance level. You see, maybe support and then resistance level. Market keeps bouncing, creating a level of support and resistance. Usually, we all know that retail traders will be we will be having a lot of sell orders here, and then a lot of buy orders here. A lot of retail traders will be here trying to sell the market. I hope you understand, for this market to rally down. Now, market makers also want to sell. Now they want to sell. But remember, I said that anytime you want to sell a pair, there should be a matching buy orders. You should have enough people who will be buying at the same time. Okay, so let's assume that this market makers wants to sell gold around here, but they were having let's say 10 million US dollars to sell gold, meaning they will need a lot of buyers to match up with their orders for that order to be executed. Now, because at this level, which is a resistance level, a lot of retail traders are selling, which gave the volume of, or the percentage of people selling around that level to be 80%. Their order won't be executed because the buying pressure is around, let's say, 20%. So in that case, they won't be able to execute their trade. So what they will usually do is that they will have to push the market to the upside for retail traders to think that market has broken that level, and then now it is moving to the upside. So immediately market start moving to the upside, breaks this level and it is moving to the upside. All retail traders who were selling around here, because market has break to, we will now be trading the breakout strategy. So quickly the volume or the percentage of people buying now will be what? Higher. So assuming if at first about 80% of people were what? Selling, now we can have about 80 to 90% of people what? Buying, because a major level has been what? Broken. So a lot of people will be what? Buying. Now that people are buying, then now they can what? Accumulate more liquidity to what? To execute their sell order. So they will actually push this market to a level that they will get enough liquidity to push their sell order. So immediately they get enough liquidity, they will now what? Execute their order. Then you see market falling to the extent that it what? Breaks to this level. So around here, a lot of retail traders who were trading the breakout strategy will be what? Buying this pair around there. Some will be buying here, some will be buying there. So market will just give you 10-20 pips, then suddenly market will start what? Reversing. Then before you realize, after you have what? After you have closed your sell opportunity, then the market will now what? Break through that level and then start what? Falling. That is where you'll be like, wow, I thought I had some sell orders here. I hope you understand. So usually what they do is that they trap retail traders who are what? Trading that concept of what? Support and resistance for them to what? To sell around here. The same way, if they want to buy and they realize that a lot of buyers are here, if they buy, they won't get enough liquidity to what? Or enough opposing orders to match up with their orders. So what they will do is that they will what? Push the market to the upside, to the downside. Sorry, for retail traders to think that this market has now break this level, so it's gonna what? Trend down again. So immediately what? Retail traders start what? Selling. Then they now what? Execute their order to match with the retail traders sell orders. Then now they can what? Move market to the upside. Then a lot of retail traders accounts will what? Will go, or it will wipe away. So that is basically how these banks what? Trap retail traders to what? Execute their orders. Now, if you want to follow the footprint of these retail traders, how do you do it? This is where the concept of what? Demand and supply applies. Usually, whenever they create a level and you see that they trap retail traders as a demand and supply trader, what you need to wait is that you just wait for this market makers to trap retail traders. When they trap there and these retail traders try to start to think that this market is now what? Moving to the upside, all you need is to what? To search for a possible supply zone around there. So just view back to your data or to the previous market and see. Usually there will be what? A very nice supply zone that this market makers will be targeting. I hope you understand. So they will what? Push market to the upside for retail traders to be thinking this market is now buying until they get to their level of interest. Then now they have what? Gathered enough opposing orders to what? Or enough buy orders to what? To execute their sell opportunity. So immediately they tap onto that supply area where they have their unfold orders. So quickly they will now what? Sell for this market to what? To trend down. So as a retail trader who wants to follow the footprint of the bank, what you do is that you wait for them to break that level. Target what? The nearest what? Supply zone. I hope you understand. So once it is in line with your trend, quickly you sell here your stop loss below. Take profit to the nearest support level. In market start trading, trending up down like this, and then suddenly it started creating what? A level of what? Resistance, support, resistance like this. The first thing that should come in your mind is that these market makers are trying to what? Trap a lot of retail traders. So quickly, what you have to do is that you what? You go back to the previous market before this movements or this trap. I hope you understand. To draw what? A demand zone. So in this case, because we are buying, we will be what? Drawing what? a possible what demand zone, waiting for these market makers to trap retail traders. So over here, this is exactly what will be happening. Yeah, they will trap retail traders for retail traders to think that market has what broken what a support level, hence it's gonna what fall more. Immediately retail traders what start buying around here, then they will have what enough, or start selling around here, they will now have what enough opposing sell opportunity to execute their buy trade. I hope you understand me. So quickly, when they gather enough what volume or enough liquidity, they will now what push market to the upside. They will now execute their trade, and the market will start what moving to the upside. So you realize that a lot of retail traders will what blow their account around this level. I hope that is clear. Okay, so let's see some of the examples on the real chart. So as you can see, this is pound JPY on the 4-hour time frame. So looking at the general trend as on the H4 is obviously a downtrend market. So a downtrend market because market is currently creating a lower low and a lower high, lower low, lower high. So that is an obvious what downtrend. So all we will be looking here is for a supply zone structure, so we can sell the market. So now what I want to explain is how these banks trap retail traders who are literally trading the support and resistance concept. So as you can see over here, market just created a level of what resistance and then support that has been respecting it on several occasions. Let me just move on to the H1 time frame. Maybe it's gonna be clearer over there, so you can see. So as you can see on the H1 time frame, this is so clear, this is so obvious. On the H1 time frame, this is so obvious. Market is just creating a level of resistance and then support, resistance, support, resistance, support. So this level has been respecting market for some time. I hope that is clear. That level has been respecting market for some time. So most of those retail traders trading support and resistance usually sell their pair around here. So most of them are just hiding around this resistance zone to sell pound JPY. So anytime market gets to that area, they are going to sell, because according to history, market has been what respecting that zone. I hope you understand me. So market makers who wants to sell around there, whenever they want to sell, they need matching orders. They need more buyers to match their sell orders. So in that case, if let's say they have about $10 million, for example, to sell euro, US dollar around here, they need people who will be buying the same quantity, like same 10 million pound JPY quantity, before all their what sell orders will be matched. But because most of the retail traders are trading support and resistance around here, most of them will be looking out to sell pound JPY around that area. So if this market makers wants to place their sell trade here, most of their orders is gonna be what is gonna be rejected, because they are not matching, or there are no matching orders to match that sell order. I hope you understand. So what they will do is that they will also now push money for market to what trend up, for the retail traders who are trading support and resistance to think that this market has now what changed direction. It's now moving to the upside. So now those who are selling will now switch on to buying. So they will obviously buy this pair. Some will buy it around here, others will buy after the retest, others will buy after the breakout. So once a lot of buyers are coming into the system, that is when those market makers will be like, wow, now our orders can be matched. Now we can what confidently sell into the market. So remember what I said. Usually if they want to buy or if they want to sell, they usually sell at a level of what supply. They usually sell at a supply zone. So quickly, as a retail trader who wants to follow the footprint of the bank, what you do is to just what scroll back to see exactly where they have what, a large liquidity, where they took some of their orders to draw your what, supply zone. So obviously here we can draw what, a very perfect supply zone that we will be anticipating market makers may likely take some of their orders there. I hope you understand. So as you can see, this supply zone now acted as what, a level of what, a level where market makers can what, take some of their trades. So all you need to do is to what, draw that supply zone. Now wait for market to hit that supply zone, then now you can confidently what, take your trade. So in this case, you can set your target here. It's gonna be like 1:, let me just check the risk to reward ratio. So assuming this is our take profit, so this kind of trade is going to be like 1:14, 1:14 risk to reward ratio. So you can either enter here, or you can wait for them to what, to create a level of supply zone there. Whenever they come back to that area, then you can possibly what, sell again, and then what, follow their footprint. So let me play the market for you to see exactly what I'm trying to explain. So as you can see, these market makers have now what, created a new supply zone that you could just what, pick your trade there. So in case you miss the first entry, that one will also be what, an opportunity for you to take another entry. I hope that is clear. So now let's see if they will trap retail traders again before getting to that area. I hope that is clear. If they are able to trap retail traders before getting to that area, then your setup becomes more what, valid. So as you can see now, they are creating a level of what, resistance here. I don't know if you can see, they are creating a level of what, resistance. So you see, market is trying to respect this resistance, came here, it has respected that resistance, so it is just respecting that resistance there. Let me just zoom it for you to see it clearly. So you see, so market keeps what, respecting that resistance over and over again. So 1, 2, 3 test. So until now, what, market what, breaks to that level. So if you are using that concept of the trap method, all you need is to wait for market to what, to break through that resistance, because they had on foot orders to fill. What they will do is that they will trap retail traders for them to think that this market has now break through a major resistance, so it's gonna what, trend up. So immediately they start buying, then they will now what, sell to match their what, sell orders. I hope that is clear. So obviously what you do is to what, wait for market to touch that area. You see how market tapped that supply zone, and then it started what, dropping. So in this case, this is where you can what, take your second trade up there. Your stop loss will be out there, then your take profits now goes back to the same level. Your take profit will now go back to the same level. So you see how you can what, follow the footprint of the banks, since they trap the retail traders when they are now moving market to their direction. This is one of the simplest way to what, follow their footprint. I hope that is clear. So you see, so obviously you just hit TP within a twinkle of an eye. So that is one of the ways that you can what, follow the footprint of the banks. Just wait for them. Whenever they trap retail traders and they are moving market to their direction, you wait for them and then take this. So this trade is almost about 1:12 risk to reward ratio. That is. So let's check another example on my favorite pair, which is Euro USD. So